Vibha Padalkar joins us, Managing Director and CEO with the HDFC Life Insurance. Vibha, good morning. Thank you for joining us. Now, the VNB growth was up 45% year on year for FY or for the quarter gone by. What aided to this growth?
So it was a combination of factors. We bettered our product mix. So that was one versus the same period last year. And there was a combination of that. We sold more of protection. We sold more of long-term investment products under the banner of Sanchay Plus, as well as focused on the annuity segment. So really combination of that. And protection, even in terms of individual as well as credit life, also aided this. Coupled with overall control on costs, meant that this kind of over 200 basis points expansion in margins.
Margins remain strong at 27% or 26.6. However, we did see a decline compared to the first half of this year. What led to this moderation?
We had mentioned in the first quarter itself that the margins at that time, which was just shy of 30%, about 29.8%, were really an outlier because of the very high level, about 65% plus of our newly launched Sanchay Plus product. And at that point in time, I also mentioned that as a philosophy, HDFC Life believes in a balanced product mix, and that by the end of quarter 4, we will bring down from the over 65% down to 35%. We have already, as of end of quarter 3, managed to bring it down to 35%. So this was really, now it is a more normalized margin, but you'll agree that even at these levels of a growth of 45% and the 26.6%, you'll agree that it is a very good outcome in terms of margin expansion.
Sure. Vibha, GWP grew by 15%, while profit could manage to grow by just 2% year on year in Q3. What do you attribute this muted performance on the profit front to?
Yeah, so on a year-to-date basis, 9 months, our overall Indian GAAP profits have grown by about 8%. However, that masks the fact that our back book, which is all the policies that we have sold in the past, are nicely delivering profits for us, and that our back book has generated profits and the growth has been 27%. However, the new business strain as a reason that we have written a lot more of policies this year, and growth APE has been robust at 31%. The strain that is caused has pulled down the Indian GAAP profits. However, when you read that in connection with the value of new business and the growth of 45%, the profits will unwind over a period of time as policyholders pay their premiums. So to summarize, Indian GAAP does not allow us to straight line the expenses. You hit the P&L as and when you incur it, and a large chunk of these expenses are incurred now, but the profits will unravel over the life of the contract.
Okay, shares of ULIP also have decreased to about 11% versus 22% in the 9 months FY19. What's the growth that you're seeing in this segment, and do you think you'll continue to shrink your exposure here?
So when you look at the third quarter on a standalone basis, you will see that unit linked is about a third of our business. But yes, on a year-to-date basis, it is lower. We drive product mix at an underlying channel level and not at a company level. And by that I mean bancassurance channel typically sells more of unit linked than an agency channel because of a couple of things. One is the underlying cost of acquisition. One channel might be more expensive than the other channel, as well as right selling and product suitability to the underlying customers. And so that's how we run the business, and these numbers are there in our investor presentation. So in this particular year, agency channel in the first 9 months has grown about 66%. Our online channel has grown by about 125% and so on. These channels do not sell a lot of unit linked, and so you will see that at an aggregate company level, optically it looks like we have reduced our unit linked, but really we drive it at a underlying channel level.
Right. Vibha, persistency ratio for the 9-month improved on a yearly basis. What led to this kind of bump up? And was this improvement witnessed across all segments or specific pockets?
Yes, to your second question, yes, it was. It is across, and persistency has been really a very core of what we drive as our KRA. Because if the policyholder is not convinced in paying his or her renewal premiums, then really there is a fitment issue or an understanding issue. Right selling might not have happened, so there is a focus, and several measures have helped us get there. One is that. Contactability of the customer. So a lot of focus is given on whether we have the right details at the time of sale, because if you're able to contact the customer, then our persistency there, not surprising, is very high. But if you're just not able to contact him or her, then really it is up to that person, and we are not able to give the nudge to that customer. Second aspect is that we do 100% pre-login verification to ensure fitment. Third is that we do have a fair amount of risk parameters as to how do we treat the elderly customers, what is the right kind of a product for a particular customer in a socio-economic class or in a non-metro or a non-salaried customer, and so on. And our risk team, which is separate from the sales team, is monitoring this almost on a concurrent audit basis. We do cancel a lot of policies upfront itself rather than declining a claim later on based on this risk monitoring, unless we are convinced that this is the right sale. So all of this has come together in terms of persistency being good. I must say that the persistency number that you refer to of 90% of the 13-month persistency is including single premium. So if you were to exclude single premium, it will be a bit lower. But there has been traction even if I were to exclude the single premium part of it.
Right. So if you look at the operating return on EV, there's been a decline. What levels do you see on the ROEVs, and whether they could sustain at, and what really is the outlook going forward?
Yeah, there is a slight decline, but it is more or less been in the range of about 18, 19, 19.5%, and it's more or less there at 19%. While our value of new business has grown, our VNB margin has also grown. The unwind rate is dependent on what is the prevailing interest rate and the risk-free yield curve, and that's really a macro factor and not in our hands, and so really it has been caused by a lower amount of unwind of the embedded value, and that is what is causing the a lower EVOP percentage.
Also, there are reports that term insurance prices are set to rise. When can we expect the hike and also the impact of this on growth in the near term?
The reinsurers have notified a lot of insurance companies, life insurance companies, to say that they intend to increase the reinsurance rate, and that is really what is causing a conversation about would term prices go up. I do see this happening. It is a question of when and not if. And whether companies pass on all of this to the customer or retain some, we'll have to see. One has to put this into context, because India is one of the cheapest wherein rates are all-time low, despite the quality of life or quality of longevity being a lot lesser than some of the advanced countries, and yet term prices are rock bottom. So it is not inconceivable that some correction perhaps has to take place. HDFC Life has been in the forefront of selling especially online term, and we are finding that experience of mortality, what we have seen in metros, is quite different to what we are seeing in hinterland, and really the pricing has to at some point in time take into account some of the way the experience is panning out.
Okay, must ask your expectations from the budget. The government may hike FDI limit from 49 to 74%. What would this mean for the sector and the company in particular?
So as far as the talked about hike is concerned, I think any kind of relaxation and free market is always beneficial to any industry. A lot of other industries and sectors do have it already, and hence just taking a leaf out of their book, like say telecom, no reason why insurance also should not progress to that. And to some of the naysayers who would say that this would not result in fresh funds coming in, but this would just be promoters selling out, etc. It always has to start somewhere. I'm a big believer that over a period of time, fresh money will come in to spur investment, because penetration levels are very low. I don't know in what horizon, but it is inevitable that fresh money comes in. As far as my ask of other aspects is concerned, I do believe that it is the right time for the government to give a carve out for pension, maybe similar to what they have done for NPS, to also give it for the insurance sector. Perhaps a separate carve out like that could be a win-win, that there is long-term capital for nation building for the government, as well as for people to focus in this area. And worldwide, people don't just buy long-term protection for longevity. It is usually on the back of some sweetener in terms of tax benefits, and it will be great if the government looks at that aspect.
Vibha, good to have you on the show. Thank you so much for highlighting your earnings. Quick to take.